Hello and welcome to the first edition of Tax in 10 of the new year with me, Rachel de Souza, and Andrew Robbins. We're both tax partners in RSM's London office and we have a wealth of experience in dealing with a wide range of private client matters. Your feedback is incredibly valuable to us, so do keep it coming, especially if you have thoughts on any topics you would like us to cover. We can be contacted at rachel.d'souza@rsmuk.com and andrew.robbins@rsmuk.com.
So, Happy New Year, Rachel.
Happy New Year to you too, Andrew.
I thought it would be nice to be traditional for our first podcast of 2021 and think about some tax New Year's resolutions.
Oh, okay, that sounds really exciting, Andrew. What do you have in mind?
Well, maybe not really exciting, but after Christmas, maybe we'll let ourselves in gently.
Good point.
What I was thinking is, can we please all make a New Year's resolution not to wait until right at the end of January to provide our information on tax returns to our tax advisors? It's not like you don't know that the information is going to be required. So how about for 2021 sending your details in July, rather so that we can all sleep at night during January, rather than waking up on the 29th of January and thinking, oh, maybe I should have replied to all of those emails and letters and things my poor accountant kept sending me through the last year saying, send your tax information. So, first thing on everybody's agenda for 2021, New Year's resolution, send in your tax return information early.
Goodness gracious me, you got out of bed the wrong side this morning. Yes, it's a fair point. We've all been there as advisors, so I do actually have sympathy with your view there. I think mine would be to review my portfolio and sell some assets that I've got, if I've got some standing at a gain, in order to utilise my annual CGT exemption. The exemption is actually a whopping £12,300. So in other words, I need to make gains of £12,300, and using that entire allowance will save me £2,500 in tax. That's a good late Christmas present, isn't it?
Actually, that is, I admit, a good point. But have you thought about what will happen when you die, Rachel? Because my second New Year's resolution would be to make sure you have an up-to-date will. And even if you do have an up-to-date will, think about, have you got financial and health powers of attorney? Think about this. Are your family going to be properly looked after if you get run over by a bus and either it kills you outright or you end up in a coma and unable to access all of your bank accounts?
You really are in a jolly mood, aren't you? On the other hand, I think I'm going to live for quite a long time yet. So taking a different approach, I will also ensure that I've made the maximum amount of pension contribution that I can. So for a lot of people, you can make up to £40,000 of pension contribution a year within the tax relief limits. But just as a reminder that higher earners, of course, that 40,000 limit starts to taper away. So not everyone has 40,000, but, you know, have a look and see if you can make some more pension contributions, which will see you nicely into your old age.
Well, assuming you live to your old age, when you do eventually die, which is going to happen, you can't take it all with you. So how about some charitable giving? Gift aid on charitable donations does make them highly tax efficient, and of course there is no limit on the level of gifts you can make that qualify, so long as you've got enough income in the year to offset it. And since you're not going to spend your enormous wealth during your lifetime, it's not a bad thing to share it around a bit.
Ah, okay, fair enough. And in the same vein, we shouldn't forget the best IHT present that you can do, which is to start to make gifts out of income. To qualify as a gift out of income, just as a reminder, the donor needs to have excess income above that they would normally be spending. So, you know, you've got to be, it's only for people that do have sort of more income than they're spending. And then they have to make gifts on a regular basis. If we want to take just a belt and braces approach, just to document it, I would always suggest that the donor sends a letter to the recipient saying they're going to start to make these gifts, you know, at whatever rate it might be, whether it's £50 a month, £100 a month, or whatever, £300 every quarter. And just so that when the time comes, it can be shown that this was intended to be a gift out of income, and there's the document to prove it.
Yep. A last one from me, really. Thinking about income, actually. And also, going back to my first resolution about planning ahead for tax return information, think about income generally. A lot of people do look at investing in tax efficient investments like VCTs or EIS. And of course, one of the big tax advantages there is that you get this 30% income tax credit. So the way this works is if I invest £100,000 in EIS, let's say, I get a £30,000 tax credit, which reduces my income tax liability for the year. So to take advantage of that, I need to know what my income tax liability for the year is going to be. Because if I'm only going to have a total income tax liability of 25,000, I can't use 30,000 of tax credit against it. So again, rather than leaving everything until right at the last minute and scrabbling around at the end of March to try to decide what investments to make, think about it in February. Work out, you know, roughly speaking, what do I think my income is going to be for the year? So roughly, what's my tax liability going to be? And it'll allow you then to make investments on a more rational basis, rather than on the 5th of April trying to find the last ropey VCT in the shop that nobody else wanted to put their money into, and desperately pouring your investments in there just to try to get some tax credit. Think about it early again.
Yeah, and I agree with that. And also don't forget that with your EIS investments, you can also hold over any capital gains that you've made. If you do make gains in excess of your annual exemption, think about holding over the gain. But there's a big but this year. If CGT rates rise and have risen by the time you exit the EIS investment, the CGT you will pay on the held over gain will be at the higher rate in the future rather than the current rate, which we know is 20%. So along your point of, you know, think about things now, again, if you're going to have more capital gains than will be covered by your annual exemption, think hard about whether you want to hold over gains. And again, just have that thought process done in advance rather than trying to work it all through at the last minute. So with our New Year's resolutions done and dusted, we need some light relief. What have you come up with?
Right, another podcast this week. I want to introduce the world to The Curious Cases of Rutherford and Fry, which is a BBC radio programme and podcast. They're on to about the 13th or 14th series of this now, so there are lots of them. And the earlier ones are all like 15 minutes long, typically. It's a science podcast, but don't be put off by that. It's basically Adam Rutherford and Hannah Fry investigating weird and wonderful listener queries, and it's just really good fun. The chemistry between them is fantastic. They do all sorts of quirky science. It's proper science, but it's done with a real sense of humour and fun. I really love it. And I happen to know that you did a sneak preview of this one because I mentioned it to you the other day.
I did, and I really enjoyed it. I learnt all about how many hamsters it would take to power London if they were running around their little wheels. No, it was great fun. I absolutely agree. Have a go. Thank you, everyone, for listening today. Please do let us have any comments or feedbacks that you have. We can be contacted on rachel.d'Souza@rsmuk.com or andrew.robbins@rsmuk.com. And we look forward to seeing you again next time.
Bye, everybody.